Hi, everyone. We're here from TIMIA for our webinar on female founder survey results. So we'll talk about that. We're going to start with introductions. I'll introduce myself first. So I'm president of TIMIA Capital. I joined in December 2022. Previous to that, I did angel investing and advising, and I had a startup, Judy AI, which did automated underwriting and portfolio management for small business loans. So I always like to say that as a past founder, I have a lot of empathy for all the founders out there, and especially for female founders, which we're going to talk about today. And I've got Sydney with us, who is a credit analyst. Sydney, you want to tell everyone a little bit about what you do for TIMIA?
Yeah, for sure. So I joined as an intern back in 2020 with TIMIA, did a little bit of everything, but now, as Monique said, I'm now a credit analyst full-time for TIMIA. And my main role day to day is to meet the amazing founders and learn more about their businesses. And I get to analyze their companies and work with them all the way up to the term sheet stage. So very interesting and very lucky to see all the amazing companies.
Awesome. Okay, so just a little housekeeping before we get started. There is a Q&A tab there, so feel free to ask questions along the way. And we do have a Q&A session at the end, so definitely put your questions in there. We'll also be putting some resources into the chat as we go through the webinar, and we've got some resources at the end, and we'll send it out when we send the recording of the webinar, which will be done by email within a couple days after Andy has a chance to download it and get it all ready and that sort of thing. So yeah, looking forward to providing you with some of the results and to hearing what you guys all think. So the agenda for today is we're going to go through a little bit on background, talk about the methodology and response rates. We'll dig into the research findings, what we at TIMIA see as the next steps, and then we'll go into the QA. I think the timing will go pretty fast, so I apologize if we go fast over some things. There's going to be a full report that'll come out after this as well, that'll have a lot more information in it because we can only shove so much into the webinar. So here we go. Let's talk a little bit about the project background. So I think we all kind of know there's a big problem out there, that there's lots of female founders, but they're not getting their fair share of the capital. So they're getting a measly percentage of the capital. It's really hard for them to get funding out there, and that they aren't getting the proportion of the capital either based on the number of female founders or the number of businesses that are being launched. So usually it's friends and family that are doing the early rounds, and we'll sort of talk about that a little bit more. So there's an unequal distribution of funding. We sort of all know about that. And then on the other side is there's also a scarcity of female VCs out there. So I think that, the initial hypothesis when people, started looking at this is, oh, well, women aren't getting the funding because there's not enough decision makers at the table. And definitely that's still the case. So it's improved. There's an increase in the number of women who are partners at VC firms. But that still hasn't moved the needle. Maybe it's going to take longer. Maybe 10% when it's such a small proportion to start with just isn't enough to sort of get to that critical mass. The other thing is there's more females being employed at VCs, but really it's mostly admin positions. Only 26% are in the decision-making roles, and that drops down to an embarrassing 2% when we look at Black women. So even more of a hill to climb there. So it's, not that women aren't educated and have business degrees and all of that. So, as we say, what is going on? So based on my background, and also, you'd have to be under a rock not to know that this sort of problem is out there. And I feel like we've spent several years sort of talking a lot about the problem, and now we're all trying to figure out how to be part of the solution. So last year when I came on around the same time when International Women's Day was coming up, we said, hey, let's do a blog series and we can talk about the fight of the female founder and sort of, bring all this in. And we also did some investment in education and some processes to try to level the playing field. And that was all great and everything. But at the end of the year, when I talked to Sydney and Tyson on our origination team, it was like, hey, we're still not getting that many applications from, female founders. And, it's not a case of field of dreams where build it and they will come. So we realized that, okay, we need to be a little bit more proactive. So in 2024, we're like, okay, we got to go out there and better understand the situation, proactively reach out to female founders, whether it's to understand them more or, encourage them to apply. So that's what we did. So we're going to talk about the methodology and response rates. Sydney's going to talk about this a bit because Sydney got volunteered to do this. No, she's great, but has helped do a lot on this project and in terms of the data collection. So I'll hand it over to you, Sydney. You can talk about the objectives and the methodology for us.
Yeah, for sure. So going into the goal of this project and just to give some insight, like I mentioned, day to day, I talk to a ton of founders, but I really don't get to speak and hear from that many female founders. So as much as I was voluntold, this has been a super interesting project for me. And it's really great as I go through these quick objectives here. So we really wanted to get a better understanding of the funding experience among female founders and the different challenges they face going through the funding process and looking for different funding sources. And then we also wanted to get a better understanding of the role that the different funding sources or the different funding sources that female founders and companies have. And then we wanted to investigate the awareness of overall kind of debt financing and venture debt in general, and kind of get a better understanding and hear more from the female founder side of things, just as I get to talk to way more male founders on a day-to-day basis. So going into what we did for this project. So first we identified our target. And so how we did this is mainly, of course, is for female founders. So our main target here was looking and creating lists of female founders, co-founders, and then different CXOs. Specifically within the tech industry, trying to target as many B2B technology companies as possible, with a company size ranging anywhere from about 11 to 200 employees in Canada and the United States. That's typically what we look at here in TIMIA, but that's how we kind of wanted to generalize our target here. And the way we did this is we used a couple different platforms such as Source Scrub and Sales Navigators, and we built some lists through that, as well as utilizing, some people that we have in our own database and customer lists as well. And I'll go into a little bit about the survey distribution in the next slide. So what happened is, it's great that we have these platforms like Source Scrub and Sales Navigator to create these lists, and I could make choose a bunch of filters to help me kind of curate them and bring them down a little bit more. However, one filter they do not have is female founders. So it took a really long time to go through and build a list of just female founders, and I came to a number of about 450. And then we sent that through a cold email outreach first, and we got a ton of bounce backs, so about 27%, as you can see on the slide there, which means that we only had about 330 valid emails. And unfortunately, that's not something we could totally control. And then through that initial email, we had an open rate of just under 40% and a click rate of the survey of about 8%. And then how that one is how we decided to try and increment responses by sending another message through LinkedIn posts, ads, and some LinkedIn messages as well.
Yeah, so I think part of the learning was, even with all of our efforts, it was still really hard to reach out and get some responses. We did get 34 responses in there. My background's market research, so I always want people to know that that's a pretty small sample size when it comes to quantitative research. So when we look at the margins of error, that means if we say 50%, it could actually be sort of, plus or minus 10 or more on either side. So all to say, when we think about the limitations of this, the results are directional in nature. So you'll hear me talk a lot about like the majority, most, a minority, a few, those sorts of things. But there's still some really good information that came out of here. And I think a lot of this is kind of intuitive in terms of what we hear as we go through the results. So we'll jump into that. So to start off with, we'll look at sort of the profile of our respondents.
So as you can see, just looking at the simple bar chart here, that the majority are first and second time founders. So we have, yeah, it's almost an even 50-50 split there. And then, we have some founders in there who've done it multiple times, and then some executive members that were reached out to as well.
Yeah, and I will say
Lists.
that it's really hard when you're a first-time founder. The learning curve is so steep. So if you're a second or, multiple, you really do have a leg up on just understanding the landscape and funding and what your options are and everything. So being a first-time founder, hopefully, if you've got a co-founder who maybe has been through it before, that can certainly be helpful. But it's really hard the first time around, steep learning curve.
And then kind of going into the different industries that came back through our survey and the age of the tech startup. So the majority is definitely in the age range of about 1 to 5 years. And this makes sense given the filters and targets we used, right? I think especially with the 11 to 200 employees, because, 1 to 5 years, it takes time to get things started, to build up the company, your employees, your customers. So makes sense that that would be the majority there. And then it's awesome to see the range in different industries here. It can be really easy for women-led businesses to kind of get more directed into kind of the femtech or the fashion or anything along those lines. So it was really great to see the distribution in different types of companies that came through the survey.
Yeah, I think that's kind of a stereotype that female
Yeah.
founders are just in, fashion and that sort of thing. And this totally proves that's not the case. They're in everything.
Yeah. And then Monique is going to go into kind of what founders have used previously and in the future for different funding sources. But in general, we just wanted to get a good idea of what their main use of proceeds are going to be put towards. And as you can see, it's definitely put towards growth initiatives, as the majority of founders are putting their capital towards sales and marketing, product development, hiring talent, and extending runway, which is really great to see, but it's definitely the majority put towards growth initiatives.
Yeah, and that's exactly what like lenders or VCs or angels, they want to see that it's going towards growth and being able to get the product out there. So this is kind of an interesting slide to me. So this is looking at what people have used in the past and what they're using in the future. So green being the past and blue being the future. And I sort of put this into stages. So in stage one, you do tend to use your own money and friends and family. And we can see here that a lot of the people who took part in this study, that's exactly what they did in the past. And they're trying not to do that as much sort of moving forward into the future. So you do that to start, but you don't want to be funding your company, for eternity. So then you start to look at some other options that are available. And accelerators are also great to use in the early stages. It can really help guide you, give you exposure. They usually give you a little bit of investment. They will take some equity in the business. It's not something that you're going to use like every year, every 5 years. It's sort of like an early stage thing that you do. And then you move on to the next stage, which tends to be angel investors. And there's a continuum there. So you'll get individual angel investors, big ones that everybody wants to get to hand out big checks and are very well connected. And then you also get angel funds, so groups of angels that work together. So out here out west, there's like e-funds. There's also Women's Equity Lab, which is trying to get women investors in there. Anyways, those are all great avenues. And then I've got where you go into stage 4. So generally, you're getting to where you're at the revenue stage. So some of those earlier stages, maybe you're just starting revenue, you haven't got product market fit. But then you start to look at venture capital, alternative lenders such as ourselves, and then traditional lenders such as banks or credit unions. So just to expand on this a little bit, then VCs will give you more money, but they're going to take a larger proportion of your equity, right? So they're taking part of the company and they want you to grow, and then they're looking for unicorns. They're, got lots of pressure for you to grow and have some sort of a big exit. Alternative lenders, we may not give you as much as a VC will, but it's non-dilutive. So you keep all the equity in your business. There's little sort of strings that are attached there. Now, you will pay a higher interest rate than you would at a bank or a credit union, but a bank or a credit union isn't going to give you as much as an alternative lender. So it'll be less expensive in terms of interest rate, but you're going to be like, well, you're only giving me 200 grand or something. I can't really do much with that in order to grow. And then really interesting, two other sort of potential avenues, government grants, always look for those. I think at any stage you qualify for different grants at different stages. So definitely worth the time to put the effort in. There's lots of great organizations like Granted and other ones that help you put those grants in and make you aware of them. And some cases, peer-to-peer or crowdfunding. I find this is a bit more with B2B than with B2C. You might have crowdfunding where you actually go and buy the product and help support the business that way. So anyways, that shows you that early stage, a lot in the past I've used the sort of stage 1, stage 2, stage 3, a lot are looking towards venture capital. And one of the takeaways for us is that maybe there's not awareness of alternative lenders and how that is an option and a valid funding option, and sort of the pros and cons of what we call venture debt versus venture capital. So we had some attitudinal questions that we asked here. So we're looking at venture capital versus venture debt, and this is about ownership and dilution. So I wish we also had a group of male founders to compare this to, but we focused on female founders. But interestingly, about half of the respondents said that they want to maintain complete control over their company. So that tells me that they're willing to give some away. Women tend to be very collaborative. They sort of work in teams. They don't have to be, the only one that's sort of driving things. So it shows that, having 100% control isn't, the be all and end all. But there is concern about dilution of ownership. And it is a bit more when it comes to venture capital. And that's because you get another player that's there. And so now maybe the VC is telling you what you have to do, and you aren't getting to call the shots as much. If anyone has watched Silicon Valley, there's some great examples of the potential downfalls there. And the other thing is, when you do exit, the more you're diluted, the less you're going to get. And that's the math you need to be doing, is when you have an exit, how much will you get? And you should do it based on hitting a home run, getting to second base and like striking out where you're, and how that's going to affect you based on how much of your equity you've given away. So this is where venture debt. So for those who prefer venture debt because there is no equity dilution, you can see that is really, really attractive. And especially at the early stages before, like our minimum revenue is about 2 million. So when you're 2 million to sort of 5 million in ARR, if you can bootstrap and get to that next stage, then go for VC or get acquired, then you'll have you'll get more in the end through that exit. So cost of capital. So, venture debt is a lower cost of capital than equity financing. It seemed to be, there's more that agree to that, where venture capital is a lower cost of capital than debt financing. So this is where you really need to do the math. So it is true, when you have venture debt, you've got to make your payments. There's an interest rate on the money that you've borrowed. But when you do that calculation of borrowing $1 million versus raising $1 million, it actually costs you more to do venture capital. So that's the balance, and it depends on what's important to you. And obviously there's a lot of factors that come into play. But that's sort of, we're planning on putting some resources together so you can actually determine the true cost of both options moving forward. So look for that in the future. Now, attitudes towards venture debt. So a lot of people are open to it, but of course they're concerned about high interest rates. Totally makes sense. You need to be able to look at the cost. How much runway does it give you? How is it affecting your cash flow? So definitely that needs to be there. And then we can see that some people are just don't like debt. And I totally get that in in our personal lives. We don't want to have too much debt. And even in a business, you don't want to have too much debt, but there are some, strategic ways that you can use debt to get you to that next level. And that next level, it should be all about growth, and it should be showing that you've got traction, and it should be a way to put gas in the tank and really kind of move forward. I can see it's already 2:20, so I'll go through this quick. So expectations of venture capital, huge expectations here. Everybody sort of agrees with that. The VCs always want you to grow, 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 and they're expecting, amazing growth rates, and sometimes that's hard to actually hit. And this is about negative outcomes. So you can see both have the potential. People have heard of negative experiences or outcome. Much more likely with venture capital, right? You get that pressure to grow, and if you can't grow, we're all in venture debt. We just want you to make your payments. We're happy if you grow, but you don't have to. You just have to, make your payments, and everything is good. And as we know, you can have wars, you can have plagues, you can have all economy, all sorts of stuff. It's really hard to, run a startup with everything that happens. So we'll go through the roadblocks. There's some really great quotes here, just to sort of highlight some of the issues. So Sydney, I'll let you talk for a sec here.
Yeah, for sure. So this was honestly my favorite part of the survey. We just asked some open-ended questions just to get a better feeling for what, the female founders are feeling out there. And this just ties back to the main problem, right? So access to capital and resources, you can see quoted, it's hard to get access to the right venture partners to support your growth. And if you just go into the next slide, Monique, because I think this really starts, this slide really kind of expands on that. So another roadblock that I think goes along with this is the smaller checks. So, and what I mean by that is that female founders, they can get the meetings, and that was a common quote that we saw in the survey. They can get the meetings and they get the opportunity, but, these investors, they're not willing to write as large of a check. So female founders have to work, just as hard, if not harder, to raise that same amount of money that these, male kind of founded companies are receiving. So, there's a lot more time, a lot more effort, a lot more meetings with no guarantee. And then again, just access to networks and, inside those insider connections and to investors. So Monique said something funny the other day, how it's a little bit like Narnia, you gotta hop inside or open the door, and it's into this kind of, special land, and you have to know secret world. That's what you said. And I thought that was really funny. And so, at TIMIA, we really try, if it's not a fit for our lending model, we really try to connect you with different people and some of our partners and everything. But these were some of the common roadblocks we saw.
Yeah. Now, there are a few advantages. So I think women have a measured approach to risk. So women aren't risky. Women they aren't going to gamble. They aren't going to roll the dice. They're going to look at a risk. They're going to evaluate it. They're going to mitigate it. And you don't have to worry about them failing in that sense. So I think that's a huge benefit. They're realistic. If you get a forecast from a female founder, they're going to hit that forecast as opposed to be sort of overshooting it. And I think there's unique skills and attributes. These were some of the comments, and I totally agree with this. They're more empathetic. I think they're, really in tune with their teams and with customers and all that sort of thing. So I think that can be a huge benefit. And it's a really supportive community, and everyone tries to help each other and open doors. So I think there are some benefits, in that there have been some programs that have been specific to female founders. So what do we do next? Okay, for us, we think that we're missing an opportunity, and female founders are missing an opportunity when it comes to venture debt. There's low awareness, maybe not aware of the pros and cons. And so we need to do a better job of that. For us, we're going to walk the talk. We're going to try to level the playing field. We actually changed our underwriting model to take into account if there's female founders on the team or in the C-suite and people of color. We're trying to proactively reach out and find and build relationships, increase awareness, provide resources, have some free advice. So that was part of the survey. So Sydney is going to be reaching out to any of you who did the survey with an analysis of your metrics and show you where you're strong and weak and how sort of ready you are for funding. And anyone who comes through can get that from us. There's a bunch of resources, so those may be in the chat. We'll send this out afterwards. We'll put them on our website as well. And there you go. We got 2025 here. So we can look at some questions. I want to make sure we leave time for questions and we can go back and elaborate on anything if people want. So I see there's one here. So examples of success stories or case studies of, so we do, I wish we had more female founders. We've got a couple. So Metazoa is in our portfolio, and it's a great example of a really strong and actually repeat founder has been able to use our funding and sort of grow and really create some connections there. We've also got another one, Refine Labs, which is now run by a female, and man, she's got great numbers and really hits all of her targets and is doing an amazing job there. And we've had lots of strong applications that have come through, so we're really trying to do as much as we can there. Another one, what specific steps are we taking to ensure more female entrepreneurs are aware? Yeah, I think we're putting out a series of blog posts. We're trying to put out resources, and we're going to be building on that. We put out a venture debt playbook. I know we're putting out a due diligence checklist. We're also trying to put out some, sort of tips and tricks for when you're in a tough economic time, whether it's a recession, et cetera. And as I mentioned, we're trying to put out some calculators, links to other sites. We're going to be trying to put a list of resources, like if you need to access a lawyer or an accountant or a fractional CFO, some of those things. So we're trying to make it, as Sydney, I think, mentioned earlier, to be like a connector, and try to help be that sort of network. If you're looking for an intro to a VC, if we happen to know them, or a PE company, we'll do as much as we can.
Also, sorry, just really quickly to jump in on that with that,
Yeah.
Monique, with kind of the free advice and metrics that we give as well, it's probably one of my favorite parts of my job is, like I said, analyzing those companies and then getting some feedback where the business can improve, what's doing really, really well. And if it's not a fit at the time, we really, on my end, and I know the origination team as a whole, we really try and nurture that relationship and check in on the company. And I mean, this applies to everyone, but I think that there's definitely a bigger initiative, especially with female founders and just those really strong female-led companies, to check in, how are things going. I also think that that's something we really upped in the last year or so. So that I think that's also another step we're trying to take too.
Perfect. Good point. There's another question about specific industries. Do you want to talk about that, Sid? Sort of our approach to, yeah.
For sure. So, I mean, we are pretty industry agnostic, I will say. So, I mean, the focus is really just, our bread and butter is B2B SaaS. We do look at, tech-enabled companies. So you've got that mix of SaaS, so software, and you might have a higher amount of professional services. So we will look at that. We have looked at and do look at some hardware software companies as well. So there really is a big mix, but in terms of actual, industry wise, we really do like the health tech space. We like the secure tech space a lot. Green tech is something that we've been looking more into as well. I mean, that's just to name a few. But I would say those are kind of some of the common ones that we really do. We do like, and that we notice success in as well. But I mean, like I said, we're open to looking at lots of different industries.
I think the only thing we don't like are marketplaces, and that's because because it's double-sided marketplaces, they're really hard, and you have to build up both sides. So you have to sort of get to a critical mass and revenue to make those work. So we don't do marketplaces, but other than that, I think we're pretty much out of time, and want to be respectful of everybody's time. So I know that Adamandia, you're going to be, we recorded this, you're going to send the recording out. There's going to be a copy of the report that will be sent out and made available afterwards as well. So if anyone's interested in that, you can get access to that. And we're always open. Reach out, make introductions, give us feedback if you think we could be doing more and have some ideas for that. Yeah, we're trying to do our part and be a little bit more proactive about it to be part of the solution and not the problem. That's it. Thanks, everybody.
Awesome.